Hi, this is Renugadevi. I'm working as an assistant professor in Dr. SNS Radharashmi College of Arts and Science. I belong to Business Administration Department. In this video, we are going to discuss about the TDS, that is tax deducted at source. In previous video, we are discussed about the some tax concept related to that how many persons they might be paying the tax based on their income. We have to discuss everything in the previous video, and also the detailed explanation about the income from other sources, that also we discussed in the earlier video. This video we are going to discuss about the tax deducted at source. So based on the tax deducted at source, actually, before we are going to discuss this topic, it is actually a system introduced under the IT Act 1961, should be ensure regular collection of tax at the very sources of income. In which way that particular income will be raised by the individual person. That is, what are the sources of income they are earning from each and every individual. So based on that only we have to categorize the sources of income. The first sources is income from salary, then second income from house property, third category income from business or profession, fourth category income from capital gain, the last one is income from other sources. So these are the very important sources when we are going to calculate the tax concept. So this is the main important evaluation part under the TDS. Next we move to meaning about the tax deducted at source. It means that the payer of income, that's a deductor, they might be deducts the tax before making the payment to the payee, that is a deductee. So this particular tax is then deposited with the central government on behalf of the payee. The payee can claim this amount as credit while filing their income tax return, that is ITR. So based on this concept, TDS as a payer of the income, that means we call it as the deductor. They have to pay the tax directly to the government based on their deduction. Next, what is the objective? We are going to making the TDS. The first and foremost objective is to collect the tax at the very sources of income, that is TDS. Very source is nothing but we have to make the income based on the what category. Based on the heads of income, we have to categorize. Then second objective is to prevent the tax evasion. So the tax evasion is nothing but some of the person they deny to pay the tax. That is, they are going to cheat the government without paying the tax. That is called the tax evasion. Next, third objective to ensure a regular flow of revenue to the government throughout the year. Then fourth objective, we distribute the tax burden evenly rather than lump sum amount will be paid at the year of the end. Next, can we tell the example related to the TDS is nothing but the salary payment under section 192. Second, interest from bank or post office. So, yeah, suppose if any people, any individual person, they might be paying the or fixed deposit or the either recurring deposit. They have to invest their amount. Against that amount, they are receiving the interest from bank. That interest also will be coming under the income from other sources. So this particular income also will be calculated as the tax to the government. And also post office scheme, some people they might be choosing the post office fixed deposit or the recurring deposit. So based on that only also they have to pay the tax to the government. Then third, dividend received by the any company when we are investing the person against the share or debentures. Then rent payment under section 1941. So these are the some few example related to TDS. Then some conditions related to the TDS is deducted only if payment exceeds the threshold limits specified under the law, then deducted at the rates prescribed in the Income Tax Act or Finance Act. Then third condition, the deductee can adjust the TDS credit against the final tax liability while filing the ITR return. It excess TDS is deducted, a refund can be claimed.